we will kick off. My name is Lee Harris. I am the founder and developer at Emoji Trading. Let's just erase that. That's terrible, isn't it? Here we are. So at Emoji Trading, I come up with visualizations that allow us to see what's happening with the supply and demands in various markets. We publish these visualizations for Sierra Chart, which is quite a powerful trading and charting software package. We do have a roadmap to port this to various other platforms over the next few months. And if you sign up to our newsletter at our website, emojitrading.com, we will keep you up to date with new software features, horizontal porting, this kind of thing. But what I want to do today, over the next 40 minutes or so, is really go back to basics and talk about how, with an understanding of order flow, you can start to build a consistent day trading plan. Order flow is really one of those buzzwords that means a lot of different things to different people and can appear really complicated at first. And what we aim to do at Emoji is make it extremely simple to see the underlying supply and demand that's present in the market by examining the order flow. What I've got here is a relatively simple chart. It's showing the traded volume at the bid and the ask within each candlestick. This is what's commonly known as a footprint chart, a term coined and trademarked by the software company called Market Delta. And then overlaid on this footprint chart, you'll see pink and blue boxes and some stripes and some bands and some zones. These are the visualizations which the Emoji Trading Order Flow Suite brings you by identifying patterns within the traded volume at the bid and the ask, so that you can see where there's underlying supply and demand. And if you understand what these visualizations are showing you, you can use these areas and these supply and demand events to improve your entry location, prices, and also timing, and trade in quite a low risk way. You can bring a lot of sense to what you're actually seeing in the market by interpreting the traded volume. Now, for many traders who are new to order flow, they'll look at a chart like this and they'll think, wow, you know, this looks nothing like what I'm used to. This is really quite complex, and it can be quite uncomfortable to transition from simple candlestick charts with overlays of price-based indicators into looking at the market like this. And actually what I'm going to do today in my examples is try and go as simple as possible. And we are not going to look at this type of footprint chart at all. We're simply going to look at some market context, highs and lows, and we're going to look at some of these emoji visualizations, but overlaid on a simple candlestick chart. I'm really going to take things back to basics because I want to show how this sense of context and interpreting what's going on with buyers and sellers gives you everything that you need in order to trade consistently. Now, let me reiterate, order flow is about looking at the impact of traded volume on price. Let's think for a second about why price moves. Price moves because people are buying and selling. It's not the other way around. We trade futures or stocks or forex. We refer to the area in which we trade as a market. Now, let's think about this as a comparison to real life. We go to the supermarket to buy food. We are dealing in commodities, but for some reason, when many traders trade, they will come up with concepts like moving averages and MACDs and magic Fibonacci numbers, and all these price-based indicators lead their decisions, and they take no regard for actually the underlying volume as a way of assessing the quality or the nature of what is actually going on to move price. So let's think about this in real life. Next week, we come to 1st October, autumn, for you guys in the US, and we've got the run up to Christmas. So in the consumer world, we're going to get to Black Friday in November. What happens on Black Friday? People go crazy to buy flat screen TVs at low prices. Let's think about actually what's happening here. We have got hundreds of people wanting to buy TVs at what they believe is a really good value price. It's less than their expectation of what the TV will normally be priced at. The retailer has bought in a stock of these TVs for Black Fridays. In other words, they have limited supply, and they have come up with some formula to price them low. What the retailer is actually doing is pricing them low to get people in the store, knowing that they're going to buy something else. But that's the nature of consumer electronics retail, which is for another time. But people are going crazy here because they can see there are not that many TVs available. If there was an infinite number of these TVs available at, I don't know, $200 each TV, we wouldn't have the crowd. People could come back at any point in time. But because they know supply is limited, there is not that much stuff to be sold, we have more people wanting to buy than stuff is available to sell. The retailer could capitalize on this, which in fact they will do, because they will creep the price up after Black Friday in the run till Christmas. After Christmas, then they're going to reduce the price in the January sales. But the price is moving because this latent supply and demand. And as a consumer, when it comes to Black Friday, we're really tempted because we know that this TV seems relatively cheap from our research. We also know there's limited supply. That's why we queue outside the flipping store at 5 a.m. in order to buy it, because there's limited supply. What we don't do as a consumer is plot Bollinger Bands of the price of the TV over the preceding 3 months and use that to make our decision. We don't plot a MACD of the price. We don't look at the RSI and the price momentum. We understand the supply and demand of the consumer, and we act accordingly, as does the retailer. So my question to you as a trader is, if that's how we behave rationally when we're buying a TV or a car or a house or buying something on eBay, why would we behave any differently and ignore supply and demand when we are gearing up and using leverage to trade futures, stocks, forex? Makes no sense to me. But that's the point of order flow. We are evaluating supply and demand in order to make trading decisions. So how do we evaluate supply and demand? We look for certain patterns and events which indicate changes in supply and demand. I'm going to split these into two halves. Firstly, we have exhaustion and imbalances. These are relatively simple concepts. Exhaustion is, as the name suggests, the activity that's going on, buying or selling, is becoming exhausted. So as prices go up, we would expect at higher prices, less people buy. That's economics 101, it's common sense. You might want to buy a flat screen TV for $200. At $2,000, maybe you're less keen and less people are going to be keen. So we expect that higher prices, we see fewer buyers. Likewise though, if at higher prices we're not seeing fewer buyers, we're not seeing exhaustion. So our upward move is likely to continue until such time as we do start to run out of buyers. So we're looking for lack of buyers at tops, lack of selling at bottoms. The next concept is imbalances, and what we're looking for here is imbalance between buying and selling. So when we consider the volume that traders have been asked, people who bought at market versus people who hit the bid and sold at market, we are considering the ratio of contracts that lifted the offer versus hit the bid. And if we are really out of step, typically 4 times as large, 400% imbalance, we regard the aggressive activity was out of step with the norm. So a 400% buying imbalance is an indication to us of strong buying. In other words, if 4 times as many people at the current price quote bought as sold, we feel that we got strong demand. The next concept we consider is absorption, and this is all about the art of seeing the unseen. Let's think about the order book. We've got resting buys and resting sell orders. Many traders will think, oh, there's an iceberg order, these people are out to get me. You know what? The people with the resting orders don't know you exist. The reason I know the orders exist is if I'm a large commercial trader in the crude oil market, maybe I'm American Airlines and I want to hedge, and I want to buy a gazillion barrels to hedge my fuel costs in the futures market. If I come into the market and say, you know what, I want to buy a gazillion barrels at market at this price, what's going to happen? Everyone that knows my intention is going to run the price up, so I pay more. So that's why we have iceberg orders and things like that. It's so large traders do not show their hand and force the price up for themselves. They're not out to get you and me, Mr. Retail Trader. They are trying to make their business at a sensible price within the market. So what happens when we have this large trader who has a limit order to buy or sell? Well, let's imagine the market is going up and we reach a level and suddenly there's a lot of buying activity, yet price isn't going up any further. What's actually happening? Well, it indicates that there is the presence of a large seller who, however much buying is going on, this large seller with a passive limit sell order is able to absorb all the buying activity. And this can be quite hard to see because we might see a lot of volume being traded, and it's even getting imbalances of buying, yet price is not going higher. So absorption is the art of seeing what is not happening. If we have got a lot of buying, yet price is not going up, it tells us we have got somebody who is larger, who is passively absorbing all that buying through their resting sell order. Vice versa at the bottom. If we've got a lot of aggressive selling, but we're not going any lower, who is absorbing all that selling? Somebody passively buying, and that's absorption. And we can bring that to life in emoji. Then the final concept, which we really aim to look for, is what is known as unfinished business. And it's one of my favorites. In order to understand unfinished business, we have to consider that the market is always searching for areas, prices, where buyers and sellers can meet. So the market will auction up and down, and buyers and sellers will trade, and trade will occur. At some point, if we believe in exhaustion, at some high price, we will run out of buyers. But what happens if we get to a high price and we fall back, but actually we didn't run out of buyers? We have got to a point in the market where we know we did not run out of buyers, but we fell back for whatever reason. In order for the market to understand whether there is demand beyond this point, we must revisit this price. It may only be one tick further where we run out of buyers, but highlighting unfinished business gives us a clue that we have got a price at which it is not known that we have run out of buyers. Therefore, until we revisit it, we will not know. Therefore, there is a kind of magnet effect, an inclination for the market to head back to this price. So with these simple patterns and events, which we can uncover in charts like this, and what I'm seeing on this chart, I'm just trying to bring up the highlighter. Here we go. What I'm seeing on this chart here is I've got areas of exhaustion here. This is an unfinished business price, which sure enough gets revisited. It acts actually as new supply once we break it, which can only be a coincidence. It holds combined with exhaustion. We've got an indication of exhaustion here. We made a low. So we can interpret these events by reading the footprint. But I want to get away from all this detail for now and show you how applying these concepts to market structures and events enables us to build a simple and consistent plan for our day trading. So what I've got here is the day session on a 30-minute candlestick chart of the ES futures. I trade ES and I trade CL. So we're going back about 8 days. The areas I've got on the chart, this is yesterday, this is Thursday. So here's Monday of this week, and I've got the previous 4 days. And I want to highlight a few things on this chart. I'm firstly running a half-hour candlestick. I personally like using market profile. If you haven't studied market profile, I recommend you do. It gives a very good context to the market and a framework for us to assess where the structure is. My white dotted lines that you can see on each day represent the high and low of the first hour's trading. So my thinking here is we make a range. You'll hear this referred to as the initial balance within the first hour. My black lines on each chart, on each day, what I've done here is I've taken a 21-day average true range of the day session. 21 days, why? Number of trading days in a month. You could do 300 days, I don't really mind. I just want a sense of context. And I'm projecting the average true range from the low upwards and from the high downwards. So what I'm doing is giving myself a sense of context on the day for what is high and what is low. And you'll see why I do this as we go through it. So all I'm looking at is a 30-minute chart, looking at what the first hour is and looking at where we could possibly go high or low in line with the distance we normally traverse historically. So as I look a little bit further at this chart, I can start to see a few things. Let's have a look at on which days this first hour range, the dotted white lines, break. Well, it broke here on one side only. Here we broke it slightly. We broke it here on one side. 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 This day was a bit strange. We broke it on both sides during the day. Now that was Wednesday. Why was that? Well, it was FOMC day. So we shouldn't be surprised that new information hit the market here. And why would this day behave like a normal day when there's big information, big macro information about interest rates? What we see here on this day, okay, we broke on one side. So we start to take a view that certainly on ES, the market will tend to break one side of the first hour range at some point during the day. It seems rare that it doesn't break that first hour range. It also seems rare that it breaks both sides. So if we could start to get a sense of which side it might break, we've got a trade set up that we can feel confident to look for every day. The other thing I can start to look at is where did the market end up each day? So on this day, we broke the first hour's range and we closed outside it. We had a similar thing here. We had the same thing in reverse. We broke the first hour's day to the downside and we closed low. So these 3 days, the market was kind of trending. It was going really in one direction, didn't go back. Similar situation here. We broke the first hour. We closed away from that. This was a strange day. We know why, because of FOMC. What about the other days? Well, on this day, we broke the first hour range, but we closed inside the range. Same thing happened here. We broke to the downside and we closed the day inside the range. And the same thing here. We broke the first hour's range, we closed back inside. So we can now start to assess that even on this sample of only 8 trading days, and I'd encourage you for your favorite market to do a similar exercise, get a sense of how the market behaves relative to the first hour and relative to how it closes. We get a strong sense that, well, you know what, the market will break the initial balance on one side. It's either going to keep going in one direction or it's going to get to a point where it comes back inside. Now, 2 days before FOMC day here, so this day and this day, these days look tight, very constrained ranges relative to the average true range projection I've got. Why could that be? Well, the market's uncertain. We're waiting for this big macro FOMC event. So we don't really want to go in one direction or another. We're just, happy to bounce around a little bit. What's also interesting, if you look at this final day on the chart here, look at how we got to the average true range on the day and then we came. So you can start to get a sense of context of what's really going on. And I'd encourage you, whether you trade CL, whether you trade ES, whether you trade the Bunds, pull up a simple chart like this and get a sense for how the market behaves. You have then got the basis of how to build a consistent day trading plan. And what that plan could look like is something like this. First of all, the market opens. We know it makes a range, the initial balance, so we want to look for clues on which side will the market break. Market breaks it on one side or the other. It'd be really nice if we could take that trade, but we don't want to take it like a retail trade and trade the breakout a couple of ticks inside or a couple of ticks beyond. We want to know from inside that range, we want to have a bias for which way it's going to break and be in the trade before it breaks. The market then continues, at which point we're hopefully in the trade and we're wondering when it's going to stop. So we'll be looking for signs of exhaustion, we're running out of steam, or absorption as some big passive buyer or seller who is preventing the market from going back any further. And potentially it comes back. So in an ideal simple world, we actually could be very happy with 2 trades a day. trading the break of the initial balance. I like to think of this as the inside out trade. Trade it for as long as possible, see when it runs out of steam, maybe go back the same way. As you get more sophisticated, you can scale in based on other supply and demand events, that kind of thing. But the basis for what we want to do in the market every day is trade the inside out for as far as possible. Then, depending on the time of day, how much money we've made, retired, whatever, maybe we go back the other way. So how can we use order flow to help us in this endeavor? Well, let's look at clues for which side will break. And here, I'm going to use unfinished business. Let's recap. Unfinished business is a price level beyond which we do not know if we will run out of supply and demand. What I've got here, if we look at this first day, which I think is last Tuesday, the 18th, I think it was a Tuesday, I'm using some emoji visualizations here to highlight when we have got unfinished business at the high or low of the day. And you can see on the very first 30-minute candlestick, I'm highlighting I've got unfinished business at the high of the day. So the high of the day was not high enough for us to run out of buyers. So very interesting for me if I can get an entry to trade back up. So here's my clue, and I'd like to enter somewhere down here if I can. The same thing happens on the next candle, and by the way, on the next candle, and we can see all the way up, we've got these clues. So unfinished business at the high or low of the day can give us some really strong indications, either as to which side the initial balance will break, or if we're going through the morning, it can be a good sign of continuation as well. So that really gives us a target. You know, we've got a bias, this unfinished business acting like a magnet, and I've got a target. But we've got to be patient. Just because we've got this magnet, don't just suddenly go long. I mean, on this first trading day here, the unfinished business prints. A really bad thing to do is assume that prints would be to buy. We're going to be buying near the top. We've got a target, and let's think about other activities that involve a target. How do we actually go about firing a gun or shooting somebody in the Hunger Games with a bow and arrow? Well, first of all, we locate our target. Then we draw back the bow in preparation, and then we release. Now you can liken this to finding a target, cocking the hammer on a pistol, pulling the trigger. But the point is just because we've got a target, we don't enter the market. So many traders will get their magic green arrow on the chart and buy, but actually we want to hang back. We know where we're going, then we need to find a reason to get in. So how can we use order flow to help us with those reasons to get in? What this chart is that very first day, and I've changed the periodicity of the chart to be a 7-tick reversal chart. It's a point and figure chart. Each pale grey vertical line on the chart, which you'll see here, 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 etc., represents a half-hour candlestick on my slower chart. I'm now looking inside each half-hour candlestick, and I'm highlighting exhaustion. I'm using an emoji indicator called price rejector. So what I'm doing is, as we get to the bottom of bars, I am looking to see if we are running out of sellers at lower prices. I have got my unfinished business targets here and here. This second one is actually the target that we would have seen on the half-hour chart. The first one would have been taken out before we saw it. So at the end of the first half hour, I have got a target here. I'm now looking to pull back my bow, draw the string back in order to potentially enter. So actually, I would like to enter in an area where we've run out of sellers. So I've got my target. Here is my first sign of exhaustion. We've run out of sellers. But I don't really want to enter here necessarily. We'll come back to what will make me release the bow in a moment. And again here, I've got a reason to pull back the bow. That's exhaustion as a way of seeing what's what. Let's consider the other concept of exhaustion. So here's the same chart. The green dash is showing me where I have got large passive buyers absorbing all the selling. So once again, we can see that we have got our areas of unfinished business here and here. And I can start to see how at the bottom of many bars, I've got large passive buyers who are absorbing all the selling. So this can give me another way of potentially pulling back the bow. So I've got areas at which I'm potentially interested to enter. And what I want to do is just combine these two charts together. And I'm going to show you the same chart where we have got both the absorption and the exhaustion. And you'll see that in this run-up initially, we don't actually have much confluence of the exhaustion or the absorption. We've got it happening at similar price levels, but we don't actually have one instance where we have got the absorption happening in an area of exhaustion. And that would be wonderful for us. We did. On this particular example, we don't have it. So I've got several opportunities to actually pull my bow back. But what shall I do about it? What's going to make me release? Well, what I've done here now is I have got the absorption as the pink and blue zones. I have got the absorption. So here's my exhaustion. I have got the absorption as my green dashes. The blue and the red areas indicate where we have got aggressive buying in blue or aggressive selling. So we can start to build a trade plan along the lines of, well, I have a target. If I have a target, I'm interested in trading for that target if I've got exhaustion or absorption combined with a trigger, a reason to enter. And what I can potentially do is, as soon as I see my target combined with pulling back the bow, now I release. Maybe I release by placing a buy stop 1 or 2 ticks ahead, and I actually let momentum take me into the market. You can start to see how I can trade with a very tight stop. This is 2 or 3 ticks in this area versus my known target. So my risk reward is really favorable. If I go beyond here and I'm wrong by 2 ticks, 3 ticks, but maybe I'm going to make 6 or 8 ticks. If I look up here, my rule can be along the lines of, well, I don't have strong buying in here, but wow, look at this next candle. I've got 4 instances of strong buying. The first one might feel a bit far away, but after I've seen 2, I'm feeling pretty confident because of where I am in the day. We're heading up to the first hour. I know my target, and you can see it holds true. So by thinking about this analogy of find a target, pull the arrow back, release it, we can slow ourselves down and discipline ourselves to really go for high probability trades based upon what is happening with the inherent supply and demand. So that gives us an example of the inside-out trade. And that inside-out trade can occur in the first hour, or actually you can see as we continue and we make new highs during the day, we still have unfinished business printing. So this is telling us that as we've gone higher and higher, we haven't run out of buyers, giving us more bites of the cherry to potentially go back in and trade to the high. So we have a target, we've got exhaustion as we pull back. You can see we have absorption, a green dot, and we have buying. Seems like a pretty good reason to enter and trade back up here. Now, we wiggled around a bit. We may have got stopped out. We may have been mindful that we have our average true range projection here. Maybe we would set that as a way of getting out. We have the same condition here again. We have some exhaustion, we have a lot of buying, and we go back up. So you get the idea that using order flow, we can be very methodical and we can trade to targets that are validated by the underlying supply and demand. So that's how we can deal with the market opening, making a range and breaking it on one side or another. And also how we can deal with it continuing. We can get a sense of, are we going to be able to go a little bit further, or should we maybe think about stopping? But how about when the market comes back? What can we do in instances like this? And we've got a really interesting example on this chart, which I highlighted earlier, which was yesterday, the 27th. So here on the 27th, we have a market that opened and made its range. It traded up pretty much to the projection of the average true range, then it fell back. So let's take a look at the order flow within this set of 30-minute candles and see what happened on the day. Here I've got my 7-tick point and figure reversal chart on this day, and the area which we're interested in looking at with the order flow is up here near the high. So we can see we broke our first hour's range and we went up to a high, we got exhaustion. Now, what's interesting for me is as we went high, we had an unfinished business. We had some absorption combined with the doji. Not sure on what we want to do. Look at this, retracements to the initial balance high and absorption, people were buying. People were buying the retrace. It continued and we got to a level maybe a point away from the projection of the average true range and we got exhaustion. We carried on a bit high though. We have exhaustion here, we've got some buying. What's interesting, we get really close, probably one tick away from this projection, we have unfinished business. But here we can start to think about the context. We're heading to lunchtime. We've gone up, we've seen exhaustion, we've seen absorption. So we could be thinking that, okay, maybe we've got to get back up here, but what's the likelihood of us really breaking this price level when we know that on average it's about as far as the market will go? So while this in itself is maybe not a reason for us to sell the market, we can think if it comes back here again, it's probably going to go lower. In fact, on this day, this didn't happen. But really interestingly, in the next bar, you can see we have exhaustion and we've got aggressive selling. Now, we could take a view, if we've made some money on the way up, I'm happy to risk, what, 6 ticks on a yes, that kind of level, to trade back down and see where we'll go to. And that outside-in trade would have been validated. Now, the past trading week's been quite strange. We've had Kavanaugh testimony moving the markets around really strongly. We've had lots of macro data from Wednesday onwards. But you can get a sense that, with no magic, I'm just looking inside the supply and demand of the prior few trading days with very few indicators and certainly no price hocus pocus indicators. All I'm looking at here are patterns going on in supply and demand. We can get a sense of context and make some very rational, very controlled, and very low risk trading decisions. So that for me is a simple way to go about building a reliable and consistent day trading plan. There really is no magic. The whole point in building your day trading career business is having tools available to you and understanding to deal with likely situations. We trade probability and we trade the likelihood of occurrences. So order flow is not a magic bullet. I mean, people email us and they go, will your system tell me when to buy and sell? And I say, no, we don't have a system. We have visualizations of what buyers and sellers are doing. It's not a magic red arrow, green arrow indicator. It helps you visualize what's going on so you can make informed decisions that will reduce your risk and increase your likelihood of being on the right side of the market. And to do that, we consider bias, we consider context, where are we relative to the market structure, and we use order flows to finesse what's happening at these levels, determine our risk-reward ratios, and minimize our risk. And all we're looking at are simple concepts. Exhaustion, are we running out of buyers or sellers? Imbalances, have we got strong buying or selling? Absorption, is there somebody who is more powerful and passive on the other side, who is stopping the market? An unfinished business. Have we reached a level beyond which it's not known whether we will run out of buyers or sellers? And we simply apply these patterns to market structure and events. And we do that day in and day out. And with this kind of approach, using order flow and just a sense of where the market is, you can build a consistent, profitable, low-risk day trading plan. So here's an email which I received yesterday morning from one of our clients, Ian, who is a relatively new trader based in Australia. He's been practicing and learning order flow over the past 1 or 2 months. And after his study, he's now progressed to sim trading for next month. And you want to see how he gets on. He has sent me a screen grab of his first sim trade, which he took yesterday. Because he's in Australia, he trades Eurex and he also trades Nikkei futures. What Ian did, which kind of blew his mind after understanding the theory, was reading the order flow. He saw that at the high of the day, we had exhaustion, and that was indicated by the emoji price rejector. He then saw that we had a selling imbalance, we had strong selling, and he entered a couple of ticks below at around 24.064. His target was down here. This is an indication of a broken level of demand. He entered the trade. He was never, as you can see, offside at all during the trade. And he realized about 200 plus ticks on his first trade, and saying his trading mate, his Australian, my trading mate, can't believe it. And he was wondering if it's beginner's luck. And I said, you know what, be mindful that this won't happen all the time, but you've read this really well and keep it up. You're on the right path. We have another trader, older gentleman, based in, where's he based? Based in Denver, I believe. He trades CL. He's come to order flow in the past 3 months. He is now 80% win rate trading CL. And the key to all of this is learning these very simple concepts, getting equipped, and being disciplined with how you apply them. So if you want to transform your trading to this style, firstly, learn the concepts and gain trust in only making your trading decisions based upon supply and demand. We can give you some indications of this at our YouTube channel, youtube.com/emojitrading. I strongly recommend that you invest in a charting platform that has a footprint. That's the market delta term for it. Sierra chart, which we like very much, refers to its numbers bars. I believe NinjaTrader now offers it in some plans, but get the ability to actually read the trader's volume. And then make your life easy with software that allows you to visualize what's going on. You can try our software with a 30-day free trial, which will really start to bring the supply and demand to life. And you can do that by visiting www.emojitrading.com/trial. So I can see that we have got a couple of minutes left. Before I hand back to Renee, I will see if there are any quick questions. If you have any quick questions, please feel free to type them in the question box, and I'll do my best to answer them in the time that remains. Seemingly not. So I've either done a fantastic job and given everybody everything they need to know, or I've blown people's minds and you all think it's rubbish. So, you know, one way or another, it's an outcome. So Renee, thank you very much indeed for having me once again at Investor Inspiration. I hope you and the audience enjoyed it, and feel free to visit us at www.emojitrading.com.
All right, well, thank you, Lee. And I did put that link in the chat box to the trial if you guys want to learn more from him, so make sure you check that out. All right, our next presenter for you all today is Peter Davies from Jigsaw Trading, and he entered the world of trading in the mid-2000s. After becoming disillusioned with the results attained by fund managers and financial advisors on his own portfolio, Peter figured that even losing money himself would be better than paying someone else to lose it for him. So he set about creating tools that presented order flow information in a more logical manner. After sharing these tools with friends, he was convinced to go commercial, and Jigsaw Trading was born. These tools are now rated the #1 financial software product on the independent review site Investimonials. Peter is also the creator of Jigsaw's Order Flow Foundation course, which is widely recommended by prop shops, trading educators, and trading rooms. All right, we will get Peter set up. Please give him a warm welcome and enjoy our next presentation.
Yeah, thank you for that introduction. We're carrying on the English theme today. I don't know, is it just the two Englishmen today, Renee, or is it a host of us?
Nope, it's just you two.
Okay, we're lucky then. Okay, so let's get started. So thank you all for coming today. This is me. Now, in this short talk, we're going to discuss something that people tend to gloss over in trading. And the fact is that most traders would fail if given a profitable setup. Now, before I explain why, let me explain how I know this. So this handsome fella you see there is me. The camera makes me look fatter than I am, I'm assured. And that's me sitting at a proprietary trading firm in London, one of the many proprietary trading firms I work with. Now, the people I work with at these firms are the traders, the management, and the people in charge of the education, the trader development programs. Now, of course, I also work with retail traders like you at home. You know, people at home who quite often year after year have been trying and failing to profit from trading. So today I'm going to give you something that will help, something that will improve your understanding of the markets within a few weeks, because you are actually going to have to do the work yourself. Something that will actually make you feel like a trader. Now, it's going to also be something that might be a little bit outside of your comfort zone. And so my expectation is that 90% of you will actually ignore this advice, but the majority that do follow it will benefit from it a great deal. Now, in the retail world of trading, the traders that get nowhere focus on this one question and nothing else, right? Now, I was recently in a prop firm where one of the traders made a 15-minute trade in Mexican peso futures. And I looked at him and I laughed and I said, what do you know about the peso? And he said it was going up, so I bought it. Now, in that trade, I think his profit for that 15-minute trade was about 20,000 US, right? And that's really, to a large extent, with some of the prop firms, that's how simple some of their trading is. So the entry is just one element of trading. And to be honest, it's not the most important element of trading. Quite often, traders, prop traders will get in and scratch a trade, get in again, scratch a trade. They're in and out, just trying to get on the right side of the market. There's nothing really scientific about the way they enter the market. But to develop as a trader, you do need to learn a method, not a complex method. But the thing is, you need to learn that method deeply to really understand it, right? So instead of having 3,000 things on your screen, you need 1 or 2,000 things on your screen that you really understand. So what you do is you learn a method. Okay, we've got the, let me just make sure my mouse is on here, my cursor visible. Right, so basically what they do in a prop firm, they will learn a method, they will trade it, they will analyze the results, and they will use those results to teach them how to actually move forward. And it's just something, and you've probably all heard of a feedback loop. So it's having a feedback loop in the trading. Now, most retail traders just focus 100% on finding some rules that define an entry and then just start clicking buy and sell. There's no process of improvement and actually no chance of improvement, right? Most retail traders, in fact, are not really taking it seriously, right? So a lot of traders that I come across, the moment you tell them to do something that's not clicking the mouse, they run away, right? So they just want to get home from work, sit at the screen. It's just a bit of excitement for them. It's boredom relief. They can go on the screen, they click buy and sell. They've got this kind of dream behind them that says, you know, if I keep doing this, I'm going to make money. But it's not really realistic. It's just like, it's just playing a computer game, right? So it's a hobby, and that's fine, you know. But for those people, anything other than clicking and buy and sell does not interest them at all. They've got like zero discipline, and that's fine. But for the serious trader, let's take a look at where a more rational and a little bit more hard work approach will get you. So this is a chart based on my experience working with both retail and professional traders. So we're not going to dwell on the blown up accounts here. I mean, I do talk to people every now and again. I'll hear somebody say, you know, I've lost $40,000, but I didn't tell my wife, you know, and to be honest, I've got nothing. I really don't even want to help people like that. I want to kind of exit as quickly as possible because it's not a relationship I want to be involved with. You know, I don't want to be involved in mentioning somebody's divorce case. So the first level of success generally in trading is I'd have made money if it wasn't for those damn commissions. And that's very common, actually, even in the professional world. That's very common for traders trading multi-leg spreads. But it is a level of success to actually be breaking even or making profits before commissions. Now, the typical first profits in the professional world in a prop firm trading outright positions, you know, buy to sell higher, is usually around $200 to $300 a day. Not big profits at all, with the imminent threat of being moved back to sim and very, very tight control of risk. Usually one strategy with a very narrow focus in terms of markets. It's kind of like you walk before you run kind of trading. Now, as a trader progresses, the ones that get through that stage, usually the first kind of, you know, as they're like, you know, getting big and getting more mature as traders, they get to the point where they're making 2,000 to 4,000 a day. Losing days are still quite possible, but now they've reached a level of success that puts them ahead of almost all retail traders, right? They've got a wider range of markets and setups, and the firm's giving them a bit more leeway in terms of how much size they can trade. Now, as they move on, the next level up is the guys that are making about $10,000 a day, which is, again, is quite normal in prop firms. So effectively, they've kind of earned the right to trade more size and they've got more trust from management. There's really not anything they're doing that differently between the 2 to 4K and the 10K level. It's just the management trusts them more. You know, they've shown they're not going to go over the top in terms of risk, but they are being more aggressive at scaling into positions, and they are able to switch quickly as the market changes pace. All markets turn into kind of a runaway mode at times, and recognizing that and being able to switch into that mode when that happens is a real key skill for prop traders. You know, so on a good day, these 10K traders, you know, they might pull in 40,000. Now, there are levels in between, but a few traders that I've met personally have progressed to a level where they're pulling in $100,000+ a day. In some cases, becoming a significant percentage of all trade on an individual market. So I've met a guy who was 30% of all of the size on one market in Singapore, right? So these are traders that they can, obviously they can be dominating a market. They're putting a lot of size. They're nudging the market around. Very, very different skill. Now, there may be traders that are bigger than this, traders are pulling in millions a day. I've just not met them personally. Now, there's a reason you need to understand this. First of all, is to stop all of this minimum wage mentality that we have in trading. I often ask people, you know, where would you like to be with your trading in 12 months' time? And they say, oh, I'd like to be breaking even, or I'd like to be clearing my commissions. And it's like, well, if that's the case, if that's your aspiration for 12 months' time, go and get a job in McDonald's, right? It'll pay you more, and you'll be out meeting interesting people. So, you know, you got into this at least partly for money. So if you want to earn $1,000 a day, don't be shy about it, and keep that in your head. Because considering how much time and effort most people put into this, there should be a decent reward. Plus, as you're putting in the time, taking it seriously and putting in the effort, it's going to be a lot easier to stay on track if you have your sights on $1,000 a day than 50 cents an hour, right? But much more importantly than this, and think about this, do you think the skills to earn 200 to 300 a day are the same as those when you get up to here and you're cornering 30% of the market, or you're making $100,000 a day? Is this here just this method scaled up? And the answer to that is of course not. But who do you think is teaching traders to corner a market like that, to get to the point where the 30% of all contracts traded on a day? You know, is there a class for that? You know, is there a course on the internet? And the answer is absolutely not. There is nobody that teaches that. It's just where those guys ended up. But it is a common place to end up for the kind of elite of the traders. So these elite traders all started off in exactly the same way, small and frequent. They gradually grew. They had a feedback loop. They let the market guide them in terms of what to do next, which is what you need to do if you're not yet profitable, right? They didn't just trade. They didn't just say, oh, I'm going to have a setup, I'm going to do that every day and make money for the rest of my life. They used the results to guide their future trading, which is why step one in our 2-week plan to becoming a better trader is selecting a single market to trade. Now, the first part is just to figure out the best fit market and best time to trade. So you're not going to get profitable trading replay, or rather, if you get profitable trading replay, let's say you trade say at night you replay the US mornings and you get profitable on it. There is no long-term plan. There is no way to get from there to becoming a full-time trader, because you can't give up your day job because you're profitable on replay. Okay, so the best thing to do is find a market to trade when you actually have the free time, and that's not rocket science, obviously. As most people are working, it's the rest of the time you have to trade. So in the US evenings, there are Asian markets you can focus on. For those on the West Coast, you can wake up earlier and trade the the New York morning. In Europe, you can trade the US close after work. And 2 hours a day is about a good target for somebody trading part-time. After the 2 weeks, the initial 2 weeks of this program, we're going to add some more review time onto that. But any more than 2 hours a day for somebody that's got a full-time job is overkill, right? There needs to be some balance. And 2 hours is a lot of time to intensely focus on something. If you've got a full-time job, you do need time to unwind afterwards too. You know, even for the retired, right? 2 hours of intense focus is still, quite intense. So what you do is you find your 2 hours a day, and based on that, you'll have a range of markets to choose from. You then need to narrow that down based on 2 factors. First, which market has a sort of volatility profile you like? You know, do you like fast markets or slow markets? Fast markets, crude oil, DAX, gold. Slow markets, ultra bonds, any interest rate products. And and also which is likely to give you multiple setups in the 2 hour period. Because to get good at something, you actually need to repeat it. And one trade a week isn't really going to cut it. So you'd need to have superhuman patience to wait a year without changing or tweaking your setup in any way to get enough statistics to evaluate a 1 trade a week method. So I have trouble getting people to go 5 days without changing their setup. So 1 year, it's not possible. So we need repetition because we need feedback as soon as possible to tell us if what we're doing is working out. Now let's backtrack a little, because what exactly do we mean by a setup, or what makes a good setup? Well, it's easy to think of what makes a terrible setup, and that is complexity. So I meet lots of traders who went out and they created a method which was a combination of all the really smart things they heard in webinars: multi-time frame analysis, day types, pre-market prep, market profile, volume profile, Fibonacci's, all that stuff, right? So many factors all mashed into one method that there's no way they could actually make consistent decisions in the moment, right? And that's aside from the fact that none of the factors were individually tested, other than, oh, that guy sounded smart. So if you walk into a futures prop firm and all they used to trade off is a depth of market. Now, sure, they look at a few charts before the market opens, but what they use to make trading decisions is very simple, and that's the ebb and flow of the market. Now, I'm not saying you can't use things like market profile or any of the things I mentioned earlier, but you can't use too many of them, and you can't use any of them if you can't actually quantify how it helps. So that's right. So it's not enough to think one of the things you use in your trading works. You must know, because anything else is guessing. So when I talk about a setup, I'm talking about a fairly rigid set of rules and limiting how many different things you look at. Something with higher frequency, something with less factors taken into account, something where you can actually specialize, something where you're not trying to guess what the bigger picture output is. But the absolute limits for our 2-week plan are 1 market and 1 setup in that market. And of course, this is where people in the audience think, well, to hell with that guy and his opinion. But if you've got 20 different setups, or you're just trading off the cuff with no plan, and you're not making money, you need to consider scaling it back a bit, just for a couple of weeks, and see what happens. So if you aren't making money now, go back to 1 setup. If you can't make money on 1 simple setup, you will not make money 2, 3, 4, or 5 setups. You won't make money trading some kind of general opinion of where the market might end up. So remember, this is a journey. Getting profitable, that's not the end goal. This, you know, the end game is to get more and more profitable, getting better and better as you progress. So your first profitable setup is a milestone, and the sooner you get to that, the better. So the setup is basically something you've observed in the market and that you believe causes a reaction. Now, I say believe because if you're not profitable yet, you actually don't know, but you will in 2 weeks' time. So if you don't have a setup, choose something with cause and effect. So there's a few examples down here. You can go to the Jigsaw site and find about these, but fading icebergs, momentum type setups, breakouts from small ranges, volume spikes. I mean, use candlesticks if you have to. And now the third part of our 2-week plan is you're going to stop trading for 2 weeks. Now, I know nobody likes me anymore. So let's just stop here. And I want you to cast your mind back, all the way back to 30 seconds ago when I said you're going to stop trading for 2 weeks. And just think about what came into your head when I said that. So a lot of you will have felt some kind of shock, some kind of revulsion, or at least some sort of negative reaction to the idea that you're not going to click buy and sell for the next 2 weeks. And some of you actually decided outright right then to ignore everything else I tell you today. So seriously, just take a minute now, go over what came into your head at the mention of not trading. So don't associate that feeling with negativity. It's not a bad thing, right? But just observe how you reacted. It's not good or bad, it's just a thing, right? So I know this because I've taken many traders through this process, and this is the one thing they had the most trouble with. They equate clicking buy and sell to trading. They equate clicking buy and sell to working, to progressing. So traders that have gone nowhere in 5 years, clicking buy and sell, still feel this way. So it's like an ingrained belief, ingrained behavior for many. And it's problematic because we need to discover if an edge works before we start trading it. So we can observe successful and failed setups neutrally without any emotional attachment. So what we see with losing traders, they're making bets on the market where they have absolutely no idea of the outcome. So what they have things that they think influence the market, but not how often or how far, or if the opposite happens often enough to reverse the setup. So it's not just that they don't know the win rate, they don't know the best approach to scaling, the stop size used. There's so many things that they don't know that they really shouldn't even be clicking buy and sell. And if you think sim trading is going to tell you the win rate of a particular setup, think again. It will not, absolutely. Because unless you're a robot, your sim trading will produce win rates lower than any setup has available. Because only when you execute perfectly can your win rate match what the setup gives. So even when you have a great setup, it takes time and practice to perfect the execution. So here's step 3. You observe the behavior, the setup for 2 weeks. You're looking to see in real time how often it occurs, what the outcomes are, what else was going on, what the correlated markets were doing. So make notes, make the sort of notes you personally will be able to use afterwards. If you're the analytical type, make some statistics, use a spreadsheet. If you're the artistic type, draw a picture, whatever you're comfortable with. So the key here is not to judge. You have to be an impartial observer. You're gathering intel on the setup so that you can define the trade rules. Now, of course, you will be tempted to trade it. And with the people I work with, I usually help them choose something to look at. So many people have a preference already. So if somebody says, well, I really like this, it's okay, let's start with that, and we'll choose some most likely candidates. Now, some people have setups they truly believe in, and let's just start there. Some have got nothing, but generally speaking, they're the exception, and it's not hard to give somebody a place to start, something to look at. So here's a good example of a trader. This comment here is a trader that found he could actually anticipate whether a setup would fail before taking it, and that he actually had 2 trades he could take from that one initial setup he was investigating. And when people do this, the feedback generally is one of not quite being able to believe what they're seeing, that this is some sort of magic trick, like, well, I've just done this for 2 weeks, how come I couldn't see all this before, or how could it be that simple? And the fact is, the trading got in the way before. If you remove the trading from the equation, you remove the emotion. It's still not guaranteeing you'll be profitable, but it does show you that it's possible. The comment here is typical. By observing neutrally, you can see here, trading the failure is also generating ticks. He's not only seeing that the setup has potential, he's also seen other factors that gives him other setups. And it's quite depressing that traders spend years getting nowhere and yet can see this stuff in a few weeks with just some assisted observation. Now, these are some stats from a trader that has 2 hours a day screen time available in the US morning. He's in Florida. It's based on a fairly simple setup on the ultra bonds. Now, this was his setup, right? I did help him choose which one to focus on, but really not that much. And I think it was his suggestion. I'm like, yeah, that sounds good. And that was my contribution. The key thing, though, this trader was 5 years in and not profitable and no idea what to do. And he was doing what a lot of people do, looking at systems, not focused on trade frequency, not focused on the time of day, trying to find lots and lots of setups to trade. And you know what? You could find a new setup every few days forever with the help of the internet. So we can see how often the setup appeared each day. We can see how often it failed. And for a 2-hour interval, this is really decent frequency. The ticks profit are all theoretical because he was observing, right? And all based on if he'd entered with market orders at the point he'd identified the setup. So there's no optimistic fills. So we saw at the end of the 2 weeks, there were 240 ticks profitable, trading 1 contract at a time. And it's $32 and change per tick on the ultra bonds. So imagine going from 5 years ago nowhere in trading to having this spreadsheet in front of you that you created based on your observations after 2 weeks. And that's what happened to this guy. So after 2 weeks, he's got actual evidence over a sample of 63 trades that there is potential edge in what he's looking at. More progress than he'd made in 6 months of sim trading. He wasn't profitable. Yeah, obviously, this is just the first step, but he can clearly see an apparent edge. He has something to work with. Now, here's another one. Different person, different technique, and again, different way of documenting the trades. So having these statistics gives people their confidence back. Suddenly they know how to look at a market, how to assess the setup. They have a degree of confidence that the market had previously beaten out of them. Now, of course, not everybody goes to plan. And there are some traders that just love to change stuff. There's always an excuse. There's always a reason to change. Oh, but that's not a change. But I didn't change anything. I just did this. That's a change, right? They change their charts. They change their time frames. They change their trading rules. They change their approach. They change the time of day they trade. And it varies from person to person. But with the sort of plan we're discussing here, consistency really is key, right? So if you do 1 week of analysis and then change the rules, you're basically throwing away the first week's work. So these are actual communications with somebody going through this process badly. So I spent an hour with this guy discussing his 2-week plan, all agreed, no problems, just observe a few hours a day and just chill out for the rest of the day, man. You can't force information into your brain. You can't force learn. So you had a decent setup to follow. And I thought there was like a decent chance that the trade location he was using would help him discover something, even if it wasn't the edge he was investigating. Now, as you can see, he's pretty diligent in recording the results, but there is one small issue here. It's like, I can open trades periodically if it does not impact my observation reading. Now, I told him exactly what I told you a few minutes ago. Sim trading will make it not work, right? So there he is. He's primarily without trading, not live, but on sim. But why? Why? Well, I think because we feel if we're not clicking buy and sell, then we're not progressing. So this trader could not bring himself to have just 2 weeks off the buy and sell buttons. Anyway, I got a daily email from him for the first 3 days telling me how great this was going. Not only could he do the observation, he could trade it too, because he could do so with no impact. So, of course, when I saw this, I'm thinking, oh, no, man. I'm like, oh, dear. But I didn't want to reply because, like, I'm not his teacher. I'm not his dad, you know. Nobody likes to be pushed around. But so I'm like, okay, whatever. After day 3, the daily update he was sending me were kind of becoming a little bit less positive. And on day 8, I actually was blessed with not 1 but 2 emails. In the first one, he's fighting the market. Now, at this point, I'm not actually sure if he still thinks he's following the 2-week plan to some extent or not, right? I don't know, maybe it's just changed each day little by little until it's completely unrecognizable. Anyway, somehow we've gone from let's observe one setup to blowing up an account in 8 trading days, right? Also, there's a comment here about being in the daily top 10 on the Jigsaw leaderboard. We run a leaderboard for our traders that people can kind of join in, and it's a little bit of a competition we do every month. And that became one of his goals, which also seemed a little bit off scope to me. It seemed like that's not what we were trying to do. And then the frustration email comes, right? And now he's looking for another method. But the trouble is, if he finds another method, guess what he's going to do? He's still not going to execute it well initially. So he's going to be exactly in the same position he's in here, round and round and round and round in circles. And some of you might recognize this, right? And if you do recognize this, stop, right? I mean, I'm not here to tell you what to do, but like, it's frustrating seeing like so many people go through this process over and over again when it's so preventable, right? So what he's doing here, you know, he's looking at Mr. Gecko as a regular winner on the Jigsaw leaderboard, a trader that scales into trades, works in a prop firm, and has a lot of experience. And this guy, Mr. You know, can't sit still and not change anything for more than 3 days. He wants that. He wants it, and he wants it right now. And he's looking at other videos of other trades, and he wants what they've got too. But what he doesn't want to do, he doesn't want to work at it. He doesn't. If something doesn't work, he just wants to get rid of it and try the next thing. And of course, you know, the grass is looking much greener when he looks at those videos, you know, from where he's standing with his approach of, well, I'm not actually sure what his approach was, or even if you could say he had an approach. But at this point, I'm figuring it's intervention time, right? You know, as I mentioned earlier, if you can't make money on one market, you won't make money on 2. And the trade in question had made a few common errors. In the first place, he had no idea if his setup had a positive outcome. And really, that's something you figure out before you start clicking buy and sell. So, you know, if you take any game that you play, like if you want to play poker, you know, you would learn the rules of poker before you sat down, right? You wouldn't sit down at poker with somebody who'd been playing who'd won the World Poker Championships on your first game, right? You learn the rules, you figure out what the odds are, you figure out how to play the game, right? You know, but he didn't want to do any of that. He just wanted to click buy and sell. He wanted to be a trader, but he traded anyway. And each losing trade made him feel bad. So instead of the losing trade being like a check mark on a spreadsheet saying, oh, here's the setup, here's the time, it went 2 ticks positive and 10 ticks negative, right? Instead of that, putting that on a spreadsheet, it was like, oh, I'm buying, oh, come on, up, 2 ticks, yeah, 1 tick, I'm right, oh, it's going against me, you know, that's just a completely different scenario, right? It's an emotional thing. And each one of those losses stacks on top of each other and just becomes, and just makes you frustrated, right? So after a few of those failures, his emotions got in the way, just like it does with 99% of people trying to learn how to trade by clicking buy and sell. And it's just not the way that people learn to trade in a professional environment, right? And there's simply no need to let this happen. Anyway, after the 2-week plan, you will get to the end of it. And by the time you get to the end of the 2 weeks, you'll be aware of some major discoveries you've made, but basically you need to sit down and review. Now, I work with traders that are a lot further through this process and some that are on to live after going through this. And one of the traders I was talking to a couple of weeks ago, he said, you know, I said, how was your week? And he said, oh, it's terrible. And I said, what were your stats? And he said, oh, I'm not really sure, but I had a really bad week. And he called me again later. He said, I was profitable 70% of the trades. And it just somehow got into his head, in the heat of the moment, somehow got into his head that he'd had a bad week. But when he actually sat down and did the stats, he actually saw that he was a lot more successful than he thought he had been. He closed some of his winners out really early, but generally speaking, he was right. He was right in his call most of the time. So you need to sit down and do a review. So don't just wing it. And the things you need to figure out is, first of all, is the merit in what you've looked at, or did it just completely break even? Was there no reaction when you saw your setup? You might find that in some cases your setup fails so well that you can just reverse it, and I've seen that, absolutely seen that before. In other cases, the simple fact of taking a step back and just watching the market actually gave you a completely different setup. Now, you might have to start the 2 weeks again at that point, but that's a really good thing. It's a really positive thing. I've seen that many times. In a lot of cases, it'll be time to start to define entry and exit rules. So it might be a low win rate system with a great risk reward. Many of the really successful prop traders I know are profitable in about 47, 49% of their trades. So the really good prop traders, really good, really profitable, 10K plus a day, you know, they're profitable half the time. Right, so a lot of setups are about a good risk reward rate and not a really high win rate. And there's different approaches to that. You can actually scale into positions. You know, if you've got a liquid volatile market like crude, you might get in small and then actually add to the position as you move on. It might be a trade where the reaction is actually fairly small, but it's a good win rate, which means you might have to go all in, all out. You know, it might be a very short-term scalp trade and there's no time to scale in, again, all in, all out. But you will have the information at this point you need to make those decisions, and then it's on to sim. Now, when you get onto sim, you have to carry on writing down the statistics, because your sim trading will not immediately match the potential of the setup. And I was talking to a guy earlier today where I'm looking at the one column, which the column is of what the setup could bring, and it's got like 10 ticks, 7 ticks, 8 ticks, 12 ticks. I'm looking at the other column, what his sim trading did, missed a trade, 2 ticks, 3 ticks. And it's like, dude, you need to let your trades run. He says, yeah, I keep closing them early, and even though my rule says let them run. But he's fine, because he knows that the one column's actually showing him what the setup can give him if he just behaves properly. And the other column of what he's actually getting out of it, well, that's what you have to work on. So your sim trading will not immediately match the potential of any setup, which is why, as I said at the start, you give a retail trader a profitable setup and they will not make it work. right? Because you give them the setup and they'll do badly at it at first, which is normal for any new trader in the new setup. They won't do very well, and they'll presume the setup works. They don't realize that it takes time to get your execution to the point where it matches what the setup has available. So, you know, the setup might be right 80%, but you're fumbling your way to 40% profitable in the first week. But as long as you know the setup's still 80%, you're empowered with information. So you've got to keep track of both the setup and your results as you move forward. And like I say, gut results, gut feel results don't work either. You have to review it properly. Now, there are additional steps you take after that, but today I said I'd just take you through the first 2 weeks. You know, nothing fancy, but you know what we discussed today is actually just common sense if you think about it, right? So figuring out if something works properly with a structured approach before you start trading it. Find out the expectancy, how far the market goes your way on winners, how far it goes against you on winners, how you really know a loser is a loser, then you can decide how to trade it. But do this in real time, right? Don't do this by looking back at old charts, right? Because what you need to be writing down are the statistics based on when you recognize that setup in real time. So going back and looking at old charts when you're not at the hard right edge, it's just not the same. So you're looking at when do you recognize these things in real time, right? And you decide how to trade it, and you know, you're going to find out when something works and when it doesn't. Like one of the mentorship students here, you know, he now realizes he's had in the past, he's had trade ideas which probably would have worked quite well, but all of a sudden they wouldn't, and he's ditched them, but he doesn't know why. You know, he doesn't know whether it was him or the market, right? You know, he's probably thrown out a lot of things that worked, you know, because now he knows how to evaluate. He can see that he'd have thrown away the very things that he's actually figured works now, because he knows now how to actually understand the difference between sim performance and setup performance. And that's how you become a better trader. So it's not about finding this really complicated secret squirrel entry. The entry is simple, you know, if a market's going up, buy it, right? It's about specializing in that entry, in that market, at that time of day, consistently reviewing the results, making sure that your trading experience becomes a learning experience. And even the traders that are making tens of thousands of dollars a day, they are still going through this process. They are still analyzing, right? And, you know, and I know this because I work with them, right? I know that these guys sit down at the end of every day and go over the results. Now, the new guys are doing it a lot more, but the experienced guys are still doing it. Now, at Jigsaw, what we do is we actually offer the only complete solution to full trader development. So the educational content we've got is second to none for order flow education, and we offer low price training that will keep you going in trading for years. So it's not the kind of training where you watch the whole thing on the weekend and you do it on Monday. It's not like that, right? It's not all or nothing. It's about layering in one technique at a time in a process of constant improvement. So for instance, there's you know, there's stuff here on trading slow markets, choppy markets like summer and December. That's not something you need at the moment. The stuff you've got on trade management, advanced trade management, it's not really something you need to focus on at the moment. But basically, the way the education works, it's a lot of stuff, and it's just as you go on and continue with your trading, you've always got materials there to lean on to help you move forward. Then we've got the tools that Renee talked about earlier, award-winning tools voted best in class by both retail and professional traders, giving you professional level tools focusing on what professional traders we work with focus on in their trading. So if your platform's got 300 indicators and is written by a bunch of nerds that can't answer questions about how you trade, using our tools is going to be a very different experience. I mean, if you look at all those indicators, you've got to ask yourself, you know, if there was one working indicator, why would you need the other 299? You know, it's just, it's all, I better not use unpolite words, but you know, you walk into a prop shop, there's no indicators at all, you know, and there's just a few charts. They just want to know where the market is overall. And then we've got the analytics, which you can see behind you here. And world-class analytics, in fact, you know, analytics to track every trade you take in real time, giving you the chance to see what's working and what isn't, so you can do more of what works and what doesn't. And then you can be in control of this process. This learn, trade, analyze, learn, trade, analyze. And for the next 24 hours only, we've actually got a really good offer for you for people who want to get their trading moving forward. Now, all packages include all of the tools, the analytics, and access to our daily chat room. Now, for those looking to improve their existing techniques, we actually have two packages. So we have the independent package here with 10 hours of the best order flow education available. And we have the professional package with an additional 7 hours covering specialist topics, information you will come back to again and again. And if you buy one of those packages, you can always upgrade later on. But for those of you who feel you've got nothing to improve upon, and that's usually the minority, we have an institutional course that includes training from all of the training from the above packages, plus a course from our proprietary trading firm partner in London. And that is a complete short-term trading course with 19 setups and a lot of drills so you can both learn and experience the style being taught. And just for today, the next 24 hours, there's actually a coupon code called INSPIRE, and you can get $100 off any of those packages. So if you are looking for the real deal, something that, if you're ready for something that rewards you for the effort you put in, this is it. And with that, I would just like to go over the questions. Anybody got a question? Somebody's asking why reinvent the wheel. I'm not really sure what that means. Another one saying, if you can follow someone that is having success, you can succeed. And I would agree with that. But if you go into a proprietary trading firm, there is nobody you can watch trade. You don't get to sit down and watch somebody trade. What happens in a proprietary trading firm, they'll tell you what to do, they'll tell you what to look for, and they'll make you do it. And then they'll tell you the next thing to do, and they will make you do that. There's a couple of reasons you don't get to sit and watch somebody else trade. First of all, it's very, very difficult for somebody to trade and give their thought processes in such a way they can do it when the market's moving on. So if you, for instance, somebody's trading off a dome and they see an iceberg order on the dome, by the time they've said, oh, you can see that iceberg, you see that 400 contracts there. By the time the word 400 has gone out of their mouth, there's 500 contracts there. And so it's very difficult to actually trade the proprietary trading style and teach at the same time. But the other thing is it's an experiential thing. You have to experience this yourself. And if you're focused on what somebody else is doing, you're not really experiencing it yourself. So basically, I mean, it's a good comment. If you can follow someone that's having success, you should succeed. And it is absolutely true. But generally speaking, the way that's done is the successful people are giving you drills to do yourself and making sure that you're empowered with the information and that you're building up yourself as a trader, right? There is no just come and sit and watch me trade and then you'll know how to do it. Because for anybody who's been in a trade room for any amount of time, if you've got people here that have been in a trade room, I've never met a single trader that got profitable looking at a trade room, right? There's probably people here that have been in trade rooms, and if you say, are you profitable? They'll probably all say no, or that wasn't a contributing factor. If we have any more questions, please ask. If not, Renee, I think I can hand back to you early, if that's okay.
All right. Well, thank you, Peter. It's a pleasure having you on. I do appreciate it.
No problem, Renee.
All right, ladies and gentlemen, our next presenter for you today is David Furiat. He is with Trade Ideas. David brings more than 20 years of experience in trading, consulting, software, utilities, capital markets, and consumer product industries. Working with senior officers and key decision makers in the boardroom, finance, HR, marketing, and trading functions, he has advised both public and privately held companies with revenues ranging from $20 million to $14 billion. Work at Trade Ideas taps experience in business development, customer acquisition and retention, corporate strategy, as well as energy trading and marketing. David holds dual Bachelor's of Arts degrees in economics and French from the University of Texas at Austin, and he has a Master's of Business Administration from the Cox School of Business at Southern Methodist University. as a SaaS fintech innovator servicing self-directed investors, financial advisors, and fund managers for over 14 years in 19 different countries. Trade Ideas leverages algorithms derived from recursive machine learning AI to develop fully formed trade plans and ideas with statistically tested, optimized performance results. Trade Ideas has earned the reputation as a premier fintech innovator for idea generation, risk management, and decision support. All right, so we will get David's screen all set up. Please give him a warm welcome and enjoy.
Can everyone hear me?
I can hear you loud and clear. If everyone else can you please just type in a yes or a Y in the chat box?
Okay, great. Looks like there's yeses there. Okay, great. I'm going to go with what you said. Hi, Renee. It's very good to hear from you.
You as well.
And welcome, everybody. It's my privilege to speak with you here today. And I want to make sure that you get as much value from our time together as possible. And the best way I know how to do that is to kind of describe a little bit of the atmospherics that are in play with your activity in the markets, and knowing what the current structure of the markets is and the tools that others are using and the technology that's being brought to bear has to be top of mind for how you participate in the market. Because if you're not aware of the latest technology, if you're not aware of where certain trends are going, you can be rest assured that others are, and they're eking out ever more profits from the market. And you want to be on the winning side of those decisions. If, as one, if you're lucky, the other, if we could all imagine the possibility of actually making our own, informed decisions, where we control a bit more of not only our lives, not only of our actions in the market, but through our own decisions rather than following anyone else. And I think that's very empowering. So the markets can sustain a livelihood and they can reward, but increasingly it requires, as a core competency, the ability to manage huge amounts of data. So here I am, I'm going to show my screen. Everyone should be able to see that now. And what I promised to do in our time together is, here we go, is to walk you through a little bit of the impact that what our version of machine learning artificial intelligence does in the market, as just a case study of this technology that's impacting not only other industries, but certainly the financial markets. And then I can, even if we have time, show you a little bit of the tool in action and how it's performing in the markets today, and certainly take some of your questions. So I think that will take us all through the time that we have allotted, which Renee will take us to, is that 2 o'clock, is that correct?
Yes, that's correct.
Okay, great. So let's bring the goods and let's talk a little bit about this shift that's happening, where we all have to recognize that we're living in a human and Holly market. And Holly, the reason why I use that term is Holly is the name of the system that is comprised of a machine learning artificial intelligence. And I'll define a little bit more of what that is in a moment. And to premise this for a bit, Trade Ideas is a software provider. We are not a broker dealership. All of the, your results with this software and this technology may vary, and we don't purport to guarantee results, from the use of this tool. It's simply because we do rely, and we do think currently that the best combination isn't just entirely AI taking over, or entirely woman or man, in decision making, but the combination of woman and machine, man and machine, make for the best combination. And we'll show you how that blend works. In fact, that blend is part of what Paul Tudor Jones, a famous hedge fund and portfolio manager, has said, which is that no man is better than a machine, and yet no machine is better than a man with a machine. And that I believe is an axiom that will continually prove to be true for the near long-term future, we can say it that way. And especially over this kind of timeline that I'm showing right now, that marks where we've been and where we are today. And I put this on the same timeline, the artificial intelligence, the use of man and machine, and even robo-advisement, these trends that we're facing today on this timeline, because it's along with these other significant changes in the market, because that's what we're experiencing today, change in the market. And that yields opportunities for those who are attuned to it, and that can yield misery for those who don't see it. Just like we had the early technicals in the 70s and 80s, the creation of technical analysis, if you will. We had the rise of the SOES bandits, the original direct market access into the trading floor electronically that was provided. SOES stands for Single Order Execution System. My partner was one of these original SOES bandits, Dan Merkin, in the 90s, and sat along some of the early software engineers that wound up building CyberTrader, which was later sold to Charles Schwab out of Austin, Texas. And then we hit the 2000s when we really changed the markets. Most people don't even remember what it was like to trade in fractions. I do, but decimalization made things a bit easier. And then we hit high frequency trading, and then we hit certain trends like big data. And now from that, we kind of arrive and evolve it with AI and robo-advisement and their impacts are having on the market. So I'll just take a couple of slides to kind of further set the table about what does this current era mean? How is it relevant, and how are you feeling this as an investor and trader? Which, by the way, I'm assuming most of the audience is. I don't know if there are professionals here, but we can certainly, in your questions, answer what we do for institutions and professionals. But I am going to keep my remarks focused more on those who I'm assuming in the audience are retail, individual investors and traders. So I'll kind of briefly go through these next couple of slides. This is just a fund flow chart that shows where the active fund flows and passive fund flows are doing over a period of time. That really is, this chart is a little bit old right now, but this was before, this was from 2016. You could already see cumulative flows of money going into passive and out of active, to the tune of a decrease of $109 billion year to date and an increase of $35 billion. This was before 2017. So in 2017 was referred to as the year of the hedge fund redemption year, where we had half a dozen to a dozen hedge funds closing because of withdrawals. And that trend has certainly continued, and I've got some updated charts here. This is a prediction as to when active managed funds and the assets in them are still predominantly larger than passive, than the assets under management in passive funds. And by passive, I mean robo-advisement, set it and forget it, kind of planned, indexed to time horizon funds. And that switchover, though, is about to occur in 2023. Some say even earlier now in 2022, where more assets under management will be under passive investment vehicles than in active. And there's nothing wrong with that. And I certainly don't mean to imply that there's going to be the death of active management funds and everything goes to zero and all of it goes into a passive index. But it does mark a kind of movement to what passive investing is, which is a sort of a very powerful heuristic that says, I would rather be average with the market, be average, which is the market, than to underperform it. And when I see active managed funds underperforming the market, that's worse than that's worse than that certainly is worse than matching what the market is. And it's so rare now for active managers to consistently perform above the market indices. And there are structural reasons why for that, by the way. When you have to have and match a particular index, like the NASDAQ 100 or even the S&P 500, you have those stocks weighted to represent that index. And so therefore, certainly in the NASDAQ 100, you have an outsized weight applied to Apple. If a fund manager had that same weighting for Apple in their fund, he wouldn't last long. He or she would not last long in that position because it's just too much exposure to one stock. But an index, that's what an index has to do. So it becomes very hard sometimes to for structural reasons to outperform certain indices. And again, this flow into passive management funds says, in a way, I'd like to set it and forget it, and I'd like to at least match what the market's going to do. And when you frame it this way, it's important to understand that that's an important part of a portfolio allocation, as much as putting it into international value or small cap growth or real estate or every other part of your portfolio. Passive will play a role, but you have to know that there's by definition there's no alpha in passive investment, because passive seeks to match the index, no more, no less, and do so with the littlest fees possible. So active management will still be around, and it will still be an important part of a portfolio allocation. And our purpose here today is to kind of show you some of the tools that are being used and that will be used going forward in active management. Okay, I'll skip over this slide. This just talks about, again, mutual fund outflows and from ETFs. The most occurred so this is an updated slide. This is from June 2018. The outflows in that month were the most seen since August of 2015. So total of 20 billion out, a little bit out of passive, but most of it out of active, just out of the market. This slide again talks more about artificial intelligence, not just in financial services, but really across all industries. And in a survey of about I think 1,000 or 2 companies by the National Business Research Institute this year, over 60% have initiated projects and adopting, again, loosely defined and defined differently among each of these companies and industries as artificial intelligence. But there is capital being spent in this area in order to improve production, improve analytics, improve the insight with which industries and companies are creating oceans of data. We have the Internet of Things that can read our temperature, read our body, read our biosignals, inform our clothing, how to react. We have devices that now connect to our homes and that turn on and automate, and that same technology applied to production is all being automated, and it all produce a huge increase in data. And that era of big data was only able to be analyzed at a fraction of what was being produced. But fast forward at the beginning of this decade, and then just in the last 4 or 5 years, as our computing power has continually increased and it's gotten more scalable to use services like AWS and Azure and so forth, you've got the capacity to process big data in such a way that you can get more analysis and analytics out of it. So that's what this slide kind of shows, is that more are using, say that they've implemented AI and the like. And again, the slide more kind of a viewpoint of how is the task of pulling out from big data analytics and decision making and analysis. And that's being driven across with these percentages of tech innovation and strategies around AI across industries. So we'll bring this back to the financial markets here with this slide. When it's part of a publication from the UK in July of this year, surveyed a collection of hedge funds using AI and machine learning, and they discovered one particular interesting insight that came out of it. Using artificial intelligence and using machine learning, from where, as I refer back to the timeline, we were, high frequency trading firms were and still are a structural part of the markets these days. And the use and evolution of AI into financial services, for many, there was the thought that this was, of course, being used to execute better. But it turns out only a third of firms and hedge funds rather are using AI for trade execution. 2/3 of hedge funds are using it to actually generate trade ideas. And I should say it's 67%, 2/3 of it using to generate trade ideas. Of this 56% who replied that machine learning, artificial intelligence is informing their decisions. But it's informing their decisions about what to trade, not necessarily how to trade and execute. Okay. Final kind of table setting slide, and we'll kind of go into a little bit more of how trade ideas as an example of all this, applies these terms and produces our value proposition. But we keep an eye on some major competitors, some that are far larger than us, like BlackRock and good old Larry Fink, who's the CEO of the firm, who suffered some pretty significant losses as I think at the beginning of 2018. It's upwards of $500 million in the first 2 months of the year. They have the capital, they have the PhDs, and they have the infrastructure to suffer a loss like that and without breaking a sweat. But it does show that, in fact, that those kinds of losses, applying machine learning AI to make these decisions, it's not an easy task. And that'll come into more relief as we kind of show you some of the performance-based results that Trade Ideas has had on its portfolio using the technology. But Larry's point here is that the page has turned and we are in a new era, and principally because if you're an active manager, you're competing with everybody who has access to information. Access is no longer the source of the advantage. That was the case in previous years. Whether you had a seat at the exchange or whether you had access to CEOs, before and above others, access is no longer in the equation because information is available everywhere. It's been democratized and it's instantly available to everyone. What has to change are the tools once you get how you use this information, and therefore the reliance on core competencies in big data. Querying it, bringing analysis out of it, using models and factors and quants are the new tools that must be used in order to continually find that advantage. I actually spoke with the CEO of Interactive Brokers, Tom Pettifree, and one of his first questions to me, I was kind of like we were in a green room and it was the leading up to, I was the warm-up act before his keynote. And in the 20 minutes or so before I went on, he was like, "Trade Ideas, tell me about you." And before I could even start an elevator pitch, he's like, "Just tell me how you're front running the market." I'm like, "What?" Because what he was using as the word front runner is this element here in this quote from Larry Fink, which is what advantage are you bringing to the market? If it's not access, what is it? And that's when I had to kind of step back, kind of understand what he was asking, and then respond with, our advantage is this ability to process big data and to present it to our clients in as elegant a way, elegant being the opposite of complex, I guess, but still sophisticated way as possible. Okay. So let's bring this back and make this a little bit more relevant. How does this pertain to the task at hand, which is we're trying to engage in the market and find alpha? Well, the problem we're solving and where our value proposition exists is in this kind of imagery between, you know, being swimming in an avalanche of data, but not in terms of information, kind of walking the desert and looking for that oasis as to how, you know, what action do I take? What's the information that that as a result of all this data that I need? And so we've talked about passive and index investing. That makes it hard to find returns in large cap stocks because of how that's all arbitraged by so many overlapping. I mean, there are more funds out there than there are stocks in the market, publicly traded stocks in the U.S. market. The sense of for your advisors who you know, who you use and who also we encourage, you know, to look at trade ideas and are seeking this kind of information and who are trading on behalf of their clients. There's a lot of advisory fee pressures for those to provide service and not have their clients throw up their hands and say, you're not cutting it anymore, and I'm going to put all this money into, you know, a Vanguard index fund and not pay any fees. The need to differentiate by those firms, the lack of performance-based research, and then still we have siloed data sets like technical. So people make decisions these days about, well, let's look at it from a technical basis, and then let's look at the same opportunity on a fundamental basis and layer that in. And then let's look at something else that we may find which involves either social media or there's data sets out there that even show you the proximity of phones to certain retailers in order to determine, hey, there's traffic with the old cars in the parking lot of the mall used to be models. And they're all siloed. They're all separately, it's almost a separate analysis. And part of the big data competency is how do you blend all that data together and then pull out of the patterns across all these data sets. So what Trade Ideas brings in terms of its machine learning artificial intelligence is the ability to assess and adapt. And we do this, you'll see this in action in a moment, but the system learns in real time what conditions is it operating under for everything that it's prepared overnight and everything that it puts in front of our clients in the morning. How does the result of that overnight research, does that perform in the markets each day in real time? And so the system will generally have two flags that it raises, a risk on and risk off, to help show the real time where the momentum is, you know, in the market. I don't mean momentum in the sense of like trend, but what are the conditions? It's like looking at a weather map and being able to understand quickly where the conditions are right or whether conditions are not right, they're not favorable. The risk on flag says the market is in fact trending, the trades and the trading plan in effect should continue, and maybe even longer than some of the parameters that have been initially set. So that could be profit targets, that could be hold time targets. You can carry them for longer to the end of the day and even beyond. And it leverages, again, momentum that it sees in the market. Whereas risk off is quite the opposite. It means take risk off of the table. Don't let profits turn into losses just because a hold time parameter or you know, or a profit target isn't met yet. If there's a profit, take it off the table. Because the markets are choppy, because what it sees in what it's looking at is not tenable or sustainable. And it's weaving between these two kinds of conditions that help in real time the AI to serve as a sort of virtual analyst, sitting there and guiding and providing guide rails to decisions. Because it's way too easy, as we know, to get an idea from someplace, from CNBC, from the Wall Street Journal, from a neighbor, from a dentist, anywhere. It's easy to get in. It's not so easy. Not so easy. There's often nothing discussed about how to get out. But this virtual analyst, if you will, is constantly kind of showing the degree in which we're in a risk on and risk off environment and how and when, if that changes. And I'll say this is an important point that is a source of optimism that I have about the business and about what we do. And we do change lives, and how you can build a life, being sustained by the markets. The following is kind of where I draw all this optimism, and it's simple. Well, in any investment and trading decision in the market, there are 4 and only 4 outcomes. And we are trying to get into 3 of those 4. You can guess what they are. There's a big loss, a big win, small loss, and that's all. A big win, small win, big loss, small loss. All we're trying to do, we'll take a small loss any day. We'll obviously take a small win. And big wins, yes, may I have another. All we're trying to avoid is the big loss. So if you're parachuting in, or if you're trying to determine an outcome, and 3 of those 4 scenarios are safe and only one's wrong, that you don't want to land in, that's what our system tries to do. It tries to avoid large losses. And that means you've got a 3 out of 4 chance of being satisfied with the decision, if properly informed. And that to me it brings great comfort. And it's something we're able to achieve consistently, which is also another source of, it'd be great to think about this, but not be able to perform or execute that. All right. This is what we mean by executing on and helping people land in 3 of those 3 out of 4 squares. What you're looking at is the performance just up to June of this year, Q1 and Q2, the long-short portfolio analysis of all the ideas, all the ideas taken by Holly and the system. So what we run is a portfolio. We have to create some kind of benchmark in order to show the performance. And the way we construct this portfolio is not necessarily the way that you might, depending on your risk parameters as well. But for the sake of at least informing what kind of results that we get, we make clear that this is $1 million portfolio, that for each idea submitted by Holly each day, takes an $80,000 position. So a maximum of 12 positions, before all the capital is used. That that rarely happens. It's more often the case where positions are left, and then capital's freed up, and then more is applied, because we often will have, sometimes, not all the time, but more than 12 trades in a day. And that kind of explains that. But $80,000 per position. And then for our portfolio analysis, all of the trades, whether it's risk on or risk off, at the maximum, all the trades are held until the end of the day. So the end of the day, the system goes to cash. And the reason why we do that, it's important to note, is because that may sound like, well, this is an intraday trading system. It's not. Again, because it's not auto trading for our clients, we provide the ideas, we provide the guidelines for the optimized trading plan, provides the guidelines for being in that trade, as well as the real-time assessment of a risk on and risk off. All those guidelines are meant to be the first indicator of where you would, for instance, the profit target is reached in a risk on environment. It says it's not time to take profits. On the contrary, you could take half the position. You could certainly double it if you think that the risk on and the opportunity and how it all looks on the chart and your analysis would lead you to believe to make perhaps double the position. You can. So how all of this gets interpreted is also the basis for all the variation. If everyone were auto trading these ideas, we'd quickly extinguish the value. We'd arbitrage everything out. But by providing and only providing the analytics, we allow a lot of, not everyone can follow or should follow all the instructions, or will, because of their ego, because of their own training, because of what they bring to the market. We are focused though on providing as clear information to help with the guardrails of making a decision and helping you do so consistently. So let me go back to why again we go to cash at the end of the day. The reason is because we never wanted any of this 54% to be the result of, say, holding Home Depot for 3, 4 months, 6 months. Home Depot has been a great stock. You know, if you've held it for a year, you've done fantastic. What we wanted to show was that all of this return, this 54%, is a result of each day's performance in the market, either adding to or subtracting from a cumulative performance. So that's just for our purposes, because if I could show you this 54% and maybe half of it might be attributed to being in the Home Depot position for 3 months, and it would dampen what the purpose is of what we're trying to do, which is promote good performance-based trade ideas. So instead we say it all goes to cash at the end of the day, we restart. Our clients don't necessarily follow that pattern. And in fact, we also sell to institutions the record of what trades were made during the day, because they realize that if this AI was able to come up with the idea, that we think that it would have more value even after this day is over? The answer is yes. And we've actually have third-party research that's looked into the performance of the ideas and what they call drift, how much more energy or how much more return do these ideas have. And the analysis, as much as 300 basis points up to lasting up to even 20 days after the idea is generated. So this is a risk-off version. If we were following all the rules, even in a risk-on environment, if we were following all the rules as they related to risk-off, the most conservative way of looking at the performance of the AI, this is still a 17% return, well above for Q1 and Q2, well above what the SPY, the Dow Jones Industrial Average, the NASDAQ Composite, or the Russell 2000. So this is looking at it in the most consistently conservative way. What I don't show you is the combination of risk on and risk off. That's almost an hypothetical, because you'd have to get every trade right. Like, okay, this is a risk off trade, or this is a risk on trade, and it's not even worth showing you that. It's a ridiculous number of return, but it's not even practical. But just picking one, just to show what the results are, this is what risk off did. This is a similar number as before. Instead of 54, it's actually 56%, but this is all of 2017. So all of 2017 yielded a 56% return in a risk-on mode for the portfolio that we ran that year. This is what I was talking about before. This slide refers to the cumulative returns of the trading ideas after the day of the trade idea. So on the horizontal axis is time, days, and on the vertical axis is the number of the cumulative return. And interestingly enough, what it actually shows, this may be hard to read or hard to see the differentiation of color, but the larger trend line there is returns on the short side. So short ideas actually had a longer drift of returns after the day of the trade idea than long strategies or long algorithms, almost double. And that was interesting research that came out of this third-party firm called Extract Alpha that did a diagnostic, an analysis rather, of our of the year's worth of AI trading that we've been doing. And I should note that the first day of the AI, machine learning AI, as we call it, that was launched was the first trading day of 2016. So this has only been since 2016, and now we're into our third year in 2018 here, closing 2018. Okay, here is a kind of brief snapshot before I'll show you what how it all looks live. But this is an important slide where we can just kind of freeze a moment in time and kind of pull apart what's happening and what you're seeing. So I'll start with the upper right-hand corner and move to the left in a moment. But in that upper right-hand corner, you have essentially what the Holly, the system, is doing over the course of the day. And on this particular day, let's start on the far left. What you see is a graphical representation of the P&L. So at the time that this was taken, which was 12 o'clock Eastern time, actually, this is a somewhat older slide or older snapshot, but this was November of last year, so 12/10. On this day, the P&L was doing very well. It was up 2 points, 251 basis points, so $2.51 rather, which is, if you were trading 1,000 share lots, you'd be up 2,500. If you were sharing 100 share lots, you'd be up 250. In this moment, at this time, you can clearly see that the risk on flag or the risk on mode is on. It says risk on and it's on. The risk off is also profitable, but less so. So the trend was in favor of more of the results of the trading in the current market that these ideas were finding themselves in. The conclusion was a risk on day or a risk on moment. And all that was fueled by ideas coming from eight algorithms here, of which 6 were long algorithms and 2 were short. And you can see the names of these algorithms and these strategies that the system selects out of a larger pool of out of a larger inventory of algorithms that we maintain. What the system does is it goes through and it will test based on the last day's trading and even farther back all of the parameters of each algorithm, and it will change values in order to see if the more current day's worth of analysis makes this better if the values of each indicator within each strategy are changed. But it will also even add new indicators from our inventory of alerts that we have. So it will substitute, it will add, and it will change the values of existing factors within the algorithm, always in the search of a more profitable result. It will even then change the trading plan. Suppose after changing the algorithm and the indicators and the values inside of it, it turns out that the trading plan applied to this algorithm performs best in the afternoon than in the morning. So it won't even consider the algorithm until the afternoon. Suppose that it's actually found this algorithm performs better as a short algorithm looking at large cap stocks. So it will remove on a market cap basis the smaller and mid-size cap companies from its analysis. And so it will take the trading plan and it will take the actual algorithm itself and test those millions and millions of times overnight, and then arrive from an inventory of about 60 or so of these strategies. It arrives at about 8, sometimes 7 algorithms, long and short, that it's ready to give to our clients. And so these columns kind of show some more information about what the win percentage was before leading up to today, what the win percentage is in the actual today's trading, what the risk on and risk off profits are, and then how many trades have come out of these algorithms. So you can see that the bottom 3 don't have any trades as of the morning session coming through those algorithms. And then the rest of this looks as it looks. Actually, let me step over. Let me go to the left here. So this chart on the left is what the S&P did during the same day through the morning up until 12 p.m. And the point of this slide in showing the S&P is that the SPY was in a very tight range of just 60 cents from 9:30 to 12 p.m. Eastern. But during that same time, where in this range, the overall market was in a very tight range, the ideas produced by Holly, as we saw at the very beginning here, the P&L, was over $2.50 of alpha captured by the alpha, so by the AI. So over, almost over 4 times what the range in the S&P was, pulling out profits, pulling out alpha, long and short, from the market. And the results of those trades from that day, what you see just below that chart on the left here. So these are, now you can actually see the actual symbols that day that were traded from the algorithm, the breakdown and you can also see the last column here, what the exit reason was for these trades. Sometimes the time in trade was, arrived at its stop. Other times in a risk off mode, it took a profit, said profit save that profit. And other times it also in a risk off mode decided to go, and reduce its risk. In a risk on mode, it would still be in these trades, and that's where you that's the difference there. Okay. I've got just a couple. This going by a little faster than I thought, but this is a very high level view of just what the process of how we define. So definitions, again, machine learning is this ability of brute force computation, processing power, to take a huge data set and run millions and millions of basically if-then kind of statements. If this happens and it's better, then keep it. If this happens and the outcome is worse, then drop it or change it or do something else. And that kind of learning of the system is what helps develop the algorithms. And then there's a whole other component that looks at the real-time assessment of the market and how the ideas are performing. But stepping back, the inputs, as we talked about before, how do we break down the data silos? So we take in technicals, fundamentals, and non-structured data like social media and earnings, and it all flows into a historical database where we catalog everything, we document, we analyze, we even create studies, and we create our own data, derived data from the data we're receiving. So we create our own data points by manipulating some of the data that comes in. And that gets used and studied and looked at. And that goes to create what are the base strategies, this inventory of 60 or so algorithms that then what we call the quantitative combine. It's like going on and seeing the NFL players, run certain, do certain physical feats under time constraints just to assess their physical abilities, the scouting camp. That combine is what we do quantitatively with all of these algorithms as they prove themselves and say, am I waxing in this market or am I waning? Am I growing in strength or am I fading? And that's what that combine produces. It produces the daily regime of algorithms. And from there, then we were able to add filters like custom preferences. Even after the ideas are produced, some of our clients don't want to see certain types of market cap or certain types of ideas that are below their threshold for, by their governance and trading below certain market caps. So we eliminate the view of that. But we also add our risk assessment, as I mentioned, the risk on and risk off. And we also look at actual custom portfolios. So we don't necessarily use the algorithms to produce the ideas. We will look at the custom portfolios especially for professionals. We'll look at their clients' holdings, and then we will run it through the AI to say, this is where, if I were trading this is where certain, this is where I would grow the position, and this is where I would exit. And all of that is meant to lead to this alpha capture. Okay, wrapping up. Love this quote from one of our mentors, Adam Goldberg, that talks about, look, AI is no longer a point of differentiation. You are not going to, you lose if you're not using it, but you won't necessarily win if you do. It just means you gotta have it just to play the game. And I would challenge then everyone to kind of think about take a look at the range of service providers you're using, everything from your broker, everything from the actual services they provide, the other services that you use to augment what your broker's doing in terms of research, and assess, does any of this research have a performance record behind it? Does any of it have an updated way that I can assess how good these ideas are on demand? And then secondly, are those ideas being powered by something more than a notepad or an Excel spreadsheet, or how is this sausage being made? And those would be the questions to kind of turn around and ask your kind of existing providers. What are they able to produce performance results? Are they able to show you how they're coming up with the way that they come up with these ideas, and what's their plan for using some of these new techniques of big data and quant modeling and the like, and machine learning, artificial intelligence. To close, these are some of the partners with which we do work, and are very proud to have worked and continue to work for. And we've been in business since 2003, but only in the last 3 years has the AI really propelled the success of the firm. And so that's why I love talking about it, and that's why I'm thrilled to be able to spend the time with you in describing what it is we do. I'll pause the screen here. Feel free, by the way, to visit trade-ideas.com, and feel free to visit the website where you can receive a trade of the week. If you give us your email, we'll give you a trade of the week that is picked by our data scientists as a result of what the AI has kind of chooses it, makes a list, and then we pick one so that we're not so that we're varied enough that if we've done 6 biotechs in a row, we'll pick an energy company or vice versa. But the website will give you the ability to receive a trade of the week for free, and that's waiting for you there at trade-ideas.com. I'm going to pause the screen for a moment, and I'll take questions while that's happening. If Renee, if you can rather than read them myself, if you can read them for me, we can take a few questions, and I will try to pull up the application here so you can see it in real time. So Renee, if you can, are there any questions? Please don't be shy.
There was a question from Dee Dee. This says, please go back one screen. It looks like that was just sent, so it might be the last screen you had up.
Let's see. It's just got my contact information, which is david@trade-ideas.com. You can do David or info@trade-ideas.com. If that's the slide in question, that's what that refers to. Let's see. Any other questions?
That is all I see right now, but I will let you know if any more come in.
Okay. I'm doing my best here to pull up the application. We have 2 versions of it. We have many versions of our data. We have 2 versions that are a graphical interpretation of the data, a GUI interface, if you will. We have one that's downloadable, and we have another that is available on the web. And they each have slightly different capabilities. The downloadable version is a bit more advanced. We are rapidly closing that gap with what we're trying to do on the web. So I will try to show this to you in just a moment. Are there any other questions?
Nope, that's it.
Okay. Well, I'm having a little bit more difficulty than I thought pulling this up. Here we go. Okay, here we go. So I will show my screen. Everyone can see that's taking a little bit because of the sharing of the web conference is slowing a little bit down. Here we go. This is our web-based feature. And just to kind of, again, describe what it is I'm showing you, is this is my own particular layout. It has 3 charts at the top, 5-minute, a daily, and then what the S&P is doing in kind of contrasting color. And then I have a series of alert windows. None of this is the AI quite yet. What this is our other views of the market, principally the layouts that I design for my own use when I'm wanting to watch certain other items, which in this case, a blockchain volume watcher, and this one being a kind of also a blockchain SMA tracker. So if I look at see if I click on the AI channel, we have a series of channels that are different motifs, if you will, different themes on the market. And by clicking on I get a unique layout that we've designed. And so this is again another this is the web version of the tool. We can see that here we go. The AI is in a risk on mode. Risk on is a $1.05. It's had a rough morning to get there, but this is where it is right now. And then if I click on risk off, it'll show me risk off. Again, I apologize for how slow my connection has become, but there it is. If everyone can still hear me. Yeah, I'll go back to risk off or risk on. And then we'll see the list of here are the strategies. Here are the algorithms that were selected today, whether they're long or short, and how they performed. And this will all, again, populate in just a moment here. There we go. Okay, so I can rank all of this by how it's performed leading up to today. 75% win rate to as low as 59. Here are the trades today. So on support, the algorithm called on support, which is a long strategy, has traded the most at 4 times today. However, it's only won 25% of the time out of those 4. So only one of those 4 trades was profitable, and it's been a contributor toward the risk off as it's left the position. But if we had stayed in it, which is what risk on is doing, it actually has turned into a profit. Right. If I click on any symbol, the results down here are the actual trades themselves. There are no trades currently open. All the trades are closed. And if I click on the symbol, I can see those charts. Let's look at a winning trade. A lot of the winning trades, by the way, have been short today. So here's KVH. Again, on the left-hand side is the daily chart. On the right is the 15-minute chart. Am I missing any questions? I haven't been looking. So quick question I will answer here. This is a system that looks only at equities and option volume data, and ETF and indices. It does not look at futures. It's a good question. What is the win rate using AI versus not? Well, both win rates I was discussing. The win rate leading up to today, that each of the algorithms has how it's performed, is really the back test of the algorithm. Is one win rate, and then the second win rate is how has it performed today in the market. So if you don't use the AI, if you don't use the AI and you use the signal, meaning I'm assuming the question is if you don't use the AI's trading plan parameters, how would you perform? Well, and that's part of the beauty. That's where your mileage would vary. We only document and what it is to use the AI in these 2 modes, in a risk on or a risk off mode. So I hope that answers your question. That's a good one. That's a good question. What was that part about the 20 days ago? Again, I missed it. Well, 20 days just referred to this one slide I had that where a third party did an analysis of all of the cumulative, the totality of all the trades, and looked at the average of how each trade, the day that it was published, and then 20 days later. And what was the average return? Did it go down? Did it go up? And over the average, these ideas had as much as the long ideas had as much as 150 basis points, and the short ideas had even more, almost 300 basis points. 20 up to 20 days after the trade idea was published. Okay. So good question, and we can end on this as well. Renee, just tell me kind of what time much I have left, and I'm happy to put an end to it. But the service, we are a SaaS model. We are a subscription-based model. So most of the other firms that are using AI do so behind the wall of an investor and a fund. We have a mission to make better decisions for our clients, no matter who they are, but to do so on the basis of getting access to this technology, right? What we talked about all throughout the hour here is that the access is what's important, and right now the service is offered as a subscription. So if you go to trade-ideas.com, you can visit our pricing page and see not just what our regular pricing is, but what specials that we have that we run. But on average, with the AI, it's an investment, and it's I think as much as $2,200, I think, for the year, which comes out to dollars a day, as we like to say, a Starbucks latte a day. And so the data that you're looking at here is a subscription, is based on the subscription, access to the AI and access to the other channels, which are significant. We have a great variety of other ways of looking at the market that use the blend of technicals, fundamentals, and non-structured data to create that lookout. And these are often used as well. For instance, a common workflow is to come in the morning and check out the pre-market, channel, and then when the markets start, many go to the AI, and others will look at find their own analysis and their own conclusions by either looking at these other layouts, or I have not even discussed the ways that you can actually, outside of the AI channel, you are able to go into these strategies and design and configure your own. So this whole conversation, and I don't mean to turn this into a product demonstration, but this conversation was about AI, but the tool itself allows you to go into and create your own algorithms, backtest them as well, and modify the ones that you see. And again, this is a little slow because of my bandwidth issue in doing this web conference and running the software, but you can create your own, you can choose among our filters, again, pre-existing strategies, alerts, and the exchanges. You can create your own view and test your own views of the market. Right. More questions. Is there anything like the AI tool in the market today? You'll have to judge that. I know that there are, we used to have more competitors, we have less now. I mentioned BlackRock as other kinds of companies who are using this technology, but as I said, they're behind a fund wall. They're behind, you have to be an investor or, in these funds to take advantage of the technology. I would say this, be careful, yet another question, if you come across vendors who are using the term artificial intelligence, as a marketing on their website, just to make sure you see the plumbing and you see where is the determination outside of the human that shows the amount of this competency, this core competency of managing big data and pulling out insights in real time. Look and ask for those kinds of questions. And the question is, why is it not used in Forex? Well, the future of trade ideas is the addition of other asset classes, and that will take us to futures eventually, and will also take us into cryptocurrencies. It also may take us into Forex, which follows, whichever you put first, cryptocurrencies or Forex, or Forex and then cryptocurrencies. But there are plans to do that, we just don't have that at this time. Right. Okay, guys, listen, it's been a pleasure. Again, visit the website at trade-ideas.com, and I really sincerely thank you for the time and your attention and spending it with me to learn about this application of machine learning and artificial intelligence. It really is a pleasure talking with you and taking your questions. So thank you very much.
All right, and thank you, Dave. It was a pleasure having you on. I appreciate you taking the time out of your day for us. All
My
right.
pleasure. Thank you. Thank you all.
All right, we have one more presenter for you all today, and that is Randy Howell from Day Trader's State of Mind. And Randy is a performance coach and licensed therapist. His work focuses on using emotions to build an effective mind for the management of uncertainty. His work is grounded in emotional intelligence, mindfulness, and developing latent potential in traders. He teaches traders how to harness emotions to achieve the performance edge so that they can effectively control the mind that is brought into the moment of managing uncertainty rather than attempting to control the outcome. All right, and unfortunately, Randy was unable to make it today. He had a personal matter to attend to, but he did send over a recording as well as a special offer for you guys. So I will get that set up now, so enjoy it. Ladies and gentlemen, I do apologize. It looks like the video I am trying to play for you guys is not working. I will see if I can do it, and if not, I will make sure it's definitely uploaded with all of today's presentations to our YouTube channel, so you will be able to check it out there. I do apologize, everybody. It looks like the video for our last presentation is not pulling up properly. I did just send out the link for a free ebook from Randy out in the chat box, so make sure you guys check that out. And I will get his presentation uploaded at youtube.com/investorinspiration along with all the other presentations for today. So make sure you guys are subscribed there. And if you subscribe, you'll be notified as soon as they are available. All right, well, that is all we have for you guys today. I do hope you enjoyed all of today's presentations and have a great rest of your day and a great weekend, and we will see you next time.